Very good morning, everybody. Thank you for joining us today. My name is Stefan Kolliber. I'm head of marketing and partnerships at BONARD, and it is my pleasure to introduce today's session. As communicated, today we will be releasing the key findings of our third edition of Student Housing Annual Report. And I'm delighted that 4 PBSA experts will join us for the panel discussion following the presentation. The session today will last up to 90 minutes. We will start first with the report data presentation by my colleague Julia Momochuk, who is our head of rented residential. And we will then continue with the panel of experts, which will be shared by our CEO, Samuel Vetrak. In order to request your complimentary copy of the report that is going to be presented today, we will share the link in the Zoom chat during the session, and we will also make sure to notify you via email after the session. I hope you will enjoy the session today, and I'm now pleased to give a word to my colleague Julia, who will guide us through the key findings of our Student Housing Annual Report 2021. Enjoy, everyone, and Julia, over to you.
Thank you, Stefan. Hello, good morning, ladies and gentlemen. I will share my screen first. If you can please, Stefan, kindly tell me if you can see it.
Yes, all good.
So far, so good, great. So, hello. I would like to welcome you to this session. Today, in the first 20 to 25 minutes, I will present, as Stefan said, the annual student housing report. This initiative in BONARD is executing every year to provide an update on the industry of student housing and where it was in the past year. Today, I will cover the topics of student demand, market saturation, student housing supply, developments, yields, transaction and portfolios. Hopefully, this intro will lay the ground for a fruitful discussion with our panel that will be afterwards. And the presentation will be distributed, so no need to take detailed notes. This note is mostly for the press and journalists, as many of them are on the session, but also others who would like to use our data other than for internal use. Please note that this presentation is protected by the copyright and should not be shared without our approval. Thank you. A bit about us, in case you don't know. BONARD is the market research and advisory firm. We are headquartered in Vienna with 14 years of experience. We completed work on more than 520 projects and have become a partner and a supplier of data, research, and consultancy for the top brands in student housing. Our model is working on subscription or ad hoc assessment reports. Going into it, I would like to start with the look on the current student housing market in the selected cities. This is the first ever seen comprehensive asset class look in the number of student housing beds available or PBSA, purpose-built student accommodation, as I will refer to it later on in the presentation. And those are split to private and non-private stock. These are presented across 32 countries, 207 cities, submarkets. They comprise 1,932,000 beds, of which 35% are private stock. This amount of beds is in over 12,000 purpose-built student housing establishments. Use a specific number on the screen. And of these, 7,000 buildings are privately owned. Not on this specific slide, but we will later on look at future student housing stock, pipeline as we call it, and recorded over to 229,000 beds in 867 buildings that actually plan to be added into the market of student housing in 3 to 5 years. Looking back at the 2021, there were several key trends characterizing student housing. When observing the performance of the sector, during last year's 2 years of the COVID pandemic, there was high, stable occupancy rates and growing rents. It was confirmed once again that the student housing sector is a resilient and a stable asset class with counter-cyclical nature. Overall, student demand has not decreased significantly, while investment appetite has remained the same or even increased during the pandemic. Students continued to travel to their destination. They preferred studying on-site over online mode and appreciated the safe and convenient PBSA environment with services and amenities. Investment demand followed the tenant demand. The size and the appetite of the institutional investment actually increased, while there is a lack of opportunities and experienced independent operators. This year, our team actually delivered more time-sensitive projects in a shorter period of time compared to the last year, and we focused on single asset opportunities. Strong demand for portfolio acquisition was another trait. The housing market in 2021 showed stronger performance compared to 2022. It was at par or even higher compared to 2019 levels. In 2021, 181 student housing properties opened across Europe, but with the growing inflation, it was not possible to increase rents at the same level in such a short period of time. Development, and namely construction costs, were heavily impacted by ongoing rising in prices of materials. Yields for student housing are predicted to compress, and the span between initial and exit yield is expected to shrink. This may result in a lower projected IRR and investment equity multiple, even under leveraged capital. We will discuss these and more topics in the detail now. As often demand defines supply, let's start with the student population for the market. With student statistics reported 1 year back after the close of the academic year, we were able to compare 2019 and 2020 developments in student population so far. And we did this across 147 cities that we constantly monitor every year. The total student population that you can see on the slide now increased in 64% of the cities reviewed. Most students were added in London. So compared to 2019, in 2020, over 32,000 more students studied in the city, while in Krakow, there was the biggest decline in student population, averaging to 8%. And this is between those cities I mentioned. We also looked at the international student population development. It also received a bump last year. This student population increased in 80% of the cities that we monitor, and over 24,000 students are now more studying in Paris, while Dublin saw 2,000 less international students last year in 2020. What is there for the students then in terms of purpose-built student accommodation? While the student population continues to increase, the housing stock tried to keep up, but still lagging behind. On this slide, BONARD has developed the market saturation benchmark of 25%. To explain a bit more what we mean by this is it's a share of beds in PBSA establishments to the total number of students in the respective city, so a percentage. And when that percentage reaches 25%, the market is considered more or less saturated. This is, however, is a theoretical benchmark that does not account for development periods in the city markets. And in reality, the universally applicable saturation benchmark across markets does not exist, unfortunately. The market develops over time. The supply comes in stages. And in accordance to that, the market adjusts as well. With a richer offer, the interest for more supply increases. In theory, now the saturation level in the UK is at the level of 31%, while Europe stands at 16%. Thus, the benchmark is in the middle for 25%, but it's not dependent on the time changes. According to 4 indicators that we combined, so this missing percentage to provision rate, the missing stock in terms of beds, the size of the student population, and the annual change of this saturation level, the most lucrative opportunities were uncovered in Madrid, Rome, Melbourne, and Paris. How the student accommodation supply looked in detail over 2021. And analyzing the common areas and amenities that current student housing product providers offered to the market, it is more or less consistent in approximately 85% of the offer, while those remaining 15% that differ building by building, they present quite a considerable difference. Most effective way to tap into the customer preference and provide the product that be fully occupied, thus the most successful, is through the primary research. For example, I remember the case we have looked at the Spanish market this year via in-depth interviews with students and the face-to-face quantitative surveys, where we collected their preferences on the room types and rent tolerance, and this straight from the market information were fit in the financial valuation that assisted to see the direct and specific indication of how much of the establishment will worth and will earn when opening. The rent benchmark, we observed sort of a propensity from public to private purpose-built student accommodation, because private PBSA handled the pandemic better. They had specific room types, for example, more studios, less shared spaces, less shared product. The defensive counter-cyclical nature of student housing was proved yet again. The COVID pandemic did not have a damaging effect on the sector, but rather confirmed the fundamentals that students are still preferring to study on site. Based on the comparison we did for private PBSA residences in 2022 versus 2022-2021, the rent increases and year-on-year change of rents in the private product across Europe was at the level of 1.1% when we talk for the studio product. Speaking of specific country markets, Denmark stood out. There was a 10% increase year-on-year, and the lowest one was in Germany. Rents grew the most in the biggest capital cities, on average by 1.7%, and the slowest at the small tier 3 markets for 0.2%. When it comes to the average monthly rent per square meter, those are two graphs on the left. Among private providers in the UK, a studio is offered for €39 per square meter, with an average size of the room of 22.6 meters square. The European average for the occupancy rate in private PBSA was 94% as of September 2021. There was an exercise we conducted across the main players to get this insight. We see on the slide that some markets did better, like Germany, the Netherlands, Belgium or Poland, France. Mediterranean countries in the UK less, but still, most of them reached 90% of occupancies. In many locations, the school did not start fully yet at the time when we requested the occupancies, so it might be possible that the rates are a bit higher now. The reason for the high occupancy is that some of the students, we believe, could defer their studies for a year, but it's very difficult to defer for 2 years and more. So students who did not come the year before are doing it the following year. How much of the PBSA stock is planning to come to the market? So we'll talk about pipeline. This is another characteristic actually of the resilience of the student housing that can be seen in a new student accommodation product in the cities we do monitor. There are 229,000 beds in the pipeline across Europe. You can see that number on the slide. The strongest pipeline among selected cities in terms of number of beds was seen in Dublin, over 8,000 beds. And of these, 2,000 are actually already in the construction stage, being built. This category by number of beds under construction is actually by Paris. We recorded over 3,000 beds that are being built there. More than 50,000 beds in over 181 BBSA assets have enriched the housing market, the student housing market in Europe in 2021. Just this 50,000 beds is the number that opened just that 1 year. And when we look at the following year, how many beds are planned to be opened in 2022, this year, actually, those are over 72,000 beds in 271 BBSAs. Year after, in 2023, 159 assets planned to be opened, adding 48,000 beds to the market. And then for 2024, we expect over 26,000 beds. We also see 364 buildings that are still not sure with the date of the opening. So they have made the plans, announced them, but not yet on the date of the opening. This brings us to the transactions. Strong focus of the investment into student housing from the end of 2020 continued to 2021. It did not slow down. 2022 was as strong as 2019, both in continental Europe and in the UK. And 2021 is shaping up nicely. We may expect now even more transaction happening after the occupancies have been confirmed across the markets in September 2021. There is a pent-up demand that is much more capital available for student housing now, especially institutional capital. We see the problem actually in the opposite. There is not enough opportunity to deploy that capital. The average transaction value per room has not changed much, as you see on the graph. Now yields. Student housing in terms of yields is way above the other asset classes, so there is still room to compress. In 2018, 19, 20, now 2021, yields either stayed or compressed. Furthermore, when we look at 10 years, the yield is usually compressed in the zone from 6% to 4.5. This is a yield game that some of the investors play in the new markets where the yields have the room to compress. The lower yields are in Germany at the level of 3.4% for the student housing, and some of the assets even might transact below 3%, as some of the transactions are shaping up. Institutionalization and consolidation of the asset class is another important topic I wanted to bring. So portfolios. BONARD is mapping out the total number of portfolios that account to 196 portfolios, that is in continental Europe and in the UK. And at the brand level, we do monitor them. And these are in the hands of 125 owners across 3,000 assets distributed. You see on the slide that there are only 32 portfolios with 5,000 beds and more, not such a big amount. The United Kingdom has the biggest share of brands focused on volume as a more matured sector, and having the biggest share in portfolio is over 10,000 beds. In continental Europe, the most of portfolios have up to 5,000 beds, and thus the further consolidation of portfolios is expected for the continental Europe, whereas in the UK, stakeholders are drifting towards strengthening of their positions. The transactable volume below is theoretical. Not many are actually selling, but still the total prospective transactable value of student housing crossed 103 billion of euros, what is represented by only portfolio assets and those 740,000 beds. Most of it is in the UK, then followed by France, Germany, Spain, and so on. Talking about specific portfolios, we've put a few examples here for the main ones. We have over 240 clients, and if you want to become one of them, or if you're a client already, maybe you would like to review our products, you can do so looking at our website. And that's it from me. Thank you for listening, for tuning in, and I give the word back to Stefan.
Thank you, Julia. I hope you can hear me. Thank you for this comprehensive overview of the key findings of Student Housing Annual Report. I will just remind that for those who are interested to get a copy, please feel free to use the link in the Zoom chat or navigate to bonard.com/presentations. As mentioned, of course, we will also notify you all by email afterwards. Now I'd like to give word to our CEO, Samuel Vetrek, who will be chairing the following panel with 4 student accommodation and student housing experts. And part of this panel, we will also have, of course, the Q&A. So I'm just encouraging everyone to pose your questions in the chat or Q&A section. Now, Samuel, if I can ask you to take the word.
Thank you, Stefan. Thank you, Julia, and also the team to put this presentation and annual report together. Few housekeeping notes. The panel will last about 70 minutes, so 60 minutes for panel, additional 10 minutes for Q&As. I would like to encourage the audience to put questions in a chat, and Stefan will select some of them to be sort of posted and presented to our distinguished panelists. And also during the next 60-70 minutes, we will have some polls that will provide all of us with the market feedback where the industry stands, as we have about 500 people in the room, so it provides a pretty good feedback. Probably before we go to the panel, a little bit of our experience where we are from the field. This year, or last year, let's say 21, we experienced much more demand and customers from the capital side of the market, and especially institutional investors from all over the world. Increase was mostly from Asia and Americas. Additional new requests that we saw, the demand was from private equity and family office, but they are looking much more for the 15% IRRs that are mostly in the new market. So we will see, we have done a lot of work in Poland and CE, Latin America and Canada, where the private equity and family offices are looking for higher returns. And also a lot of sort of demand for new opportunities, so new developments, so more assessments, city reports, financial analysis, and student surveys to measure the caliber of the opportunity and assessment. Banks seem to be also more confident, so the leverage is sort of coming back to the 2019 levels, but they are more demanding on precision and data, so we also see more reports from them. And with this sort of intro, I would like to invite our panelists, if they can turn the video on, and when they speak, also their microphone. I'm really pleased to have a very distinguished panel today, very representative panel. We have tried to invite panelists that would represent investment view, operator's view, developer view, and also from representing different regions of the world, and multiple and dozen years of experience. It's not only that the panelist represents current remit, but also cumulatively almost 100 years of experience in student housing. So I'm very pleased, and if I may call the first round of introduction, and our dear panelists can introduce themselves and the organizations that represent. So if I can start with Rosa, please, and welcome.
Great, thanks a lot for having us. Really great to be here. So just a quick intro on my side. I'm a director at KKR, leading our student housing investments across Europe. For those of us who are not familiar with KKR, we're a global investment firm. We manage more than $450 billion of assets globally. We have been very active growing our real estate presence across Europe over the past, call it 10 years. And we've had some quite successful investments in the student housing space. Now, that being said, we're still very much believers in the fundamentals of the space and very keen to invest more. And that's both actually from a value add perspective, so really developing forward funding assets, but also investing in standing stock and building scale. So quite keen to hear everyone's views on the opportunities.
Thank you, Rosa. And Thomas, can you introduce yourself?
Yeah, thank you, Samuel, for inviting me on the panel. I'm Thomas Storgard, and I am here representing Harrison Street. And for those who don't know Harrison Street, it's a leading asset management business focused on strategies across alternative sectors, typically underpinned by demographic trends or mission critical assets. Since our inception in 2005, we've invested about 47 billion across the business, of which 4 billion euros are invested in Europe. In terms of our experience in the student accommodation sector, we've invested $11.5 billion in the sector in the US and about 2.1 billion in Europe. In total, we control about 184,000 units, of which 10% are in Europe, which probably makes us one of the largest landlords across those two markets. And a little bit like KKR, I mean, we continue to be very excited about the European student housing opportunity and invest value add capital and increasing the core capital in what's, as your report clearly shows, is becoming more of a liquid market with core opportunities available.
Thank you, Thomas. Steve, over to you.
Thanks, Samuel. So I'm Steve Grant. I'm the CEO of Kinetic Capital. I've got over 20 years experience in the student housing sector in the UK and internationally through leadership roles at Unite, UrbanEst and GSA. I set up Kinetic Capital shortly after the pandemic started in early 2020 with Nick Porter, with the aim of becoming the leading provider of student housing finance globally. So a pretty ambitious target from scratch. We also launched Rise Capital, which is a $1 billion partnership with Kane Anderson Real Estate just before Christmas 2021, so a couple of months ago. And the aim of Rise Capital is to become, or really to transform the European student housing funding market. Really across Kinetic and Rise, our real USP is that we believe we understand the sector better than other lenders, having spent all of the past couple of decades in the sector. So that affords us streamlined approval underwriting processes, enables us to deliver flexible and innovative financing solutions, and really enables us to work with our borrowers to help deliver their business plans.
Thank you, Steve. And Nigel, if you can introduce yourself and tell us a bit more about Greystar.
Sure. So Nigel Alsop, Head of Research at Greystar Europe. For those of you who don't know, Greystar are rental housing specialists. We manage about 750,000 beds worldwide. With our secret sources, and this is the bit of sales pitch, but we're vertically integrated as a developer, operator, and investor. So I think we can offer a fairly well-rounded view. In terms of student housing, we manage portfolios, of course, in the US, but in Europe and in the UK, where we probably have the largest presence, the Netherlands, France, and Spain. I've been looking at student housing, I guess, for the last 10 years, and it's been just incredible. Just the ascendance of the asset class in that time is probably second only to logistics. But that's me, and thanks for having me on.
Thank you, Nigel, and thank you all. I would probably start with the first round of questions. related to look back in 2021 and look back to the presentation that we have provided, it seems like the most defining moments of 2021 were higher occupancies and rents at the same time. From most of our clients, we are hearing that it's at par or higher than 2019. Then therefore followed by higher investment demand, mostly from institutionals, on the other hand, higher inflation. How does your experience from 2021 relates to these developments or statements from me or from the presentation? And if you can start with the same order or so.
Yeah, I'm happy to kick off. I think it's definitely right that investor demand has been incredibly strong, and that more and more the demand is coming from, I would say, institutions that want to invest in the various beds sectors generally. And given that sector is still quite nascent in a lot of geographies, it means that more money is pouring into student housing, which is sort of a couple of years ahead of where build to rent is, definitely in the UK. So that's definitely something that we've seen, with the result that the cost of capital that's following these opportunities is going down and pricing is going up. So I think that's definitely one of the key things that we have seen. Similarly, and probably on a related note, I think there's a big differentiation now by quality of assets and quality of locations that perhaps historically was less pronounced. So on that note, I think ESG is a key topic, right? So I think if you look at the types of buyers that are willing to pay the highest prices, ESG is not optional, right? An asset that they buy needs to tick all the boxes. And what that means, in my opinion, is that for players like us that from a value add perspective are chasing slightly higher yield, it means that we cannot just do that. We cannot just chase yield. We have to really create an asset that the institutional market wants to own in a couple of years' time. And that, I think, has really pushed ESG on, from sort of mid or lower level of people's agenda very much to the top across all types of capital, in my opinion.
Thomas, your feelings from the last year?
Yeah, I mean, taking a slightly different angle to that of also here, I think from Harrison Street perspective, 2021 was all about buckling down and delivering against some of the asset management capabilities that Harrison Street has become recognized for over the years. So at any point in time, a business like ours will have various pressure points. We'll have a huge pipeline of projects that we've already committed to, and most of the stuff that we do in many of the markets where we're active are development-led situations. 2021 was very much influenced by the pandemic. I'm happy to say that we managed to manage our way out of this situation with a minimum amount of disruption. And then otherwise, echoing your sentiment in your report, is clear that demand is coming back from our clients, students, which is great to see. So yeah, we are embracing ourselves for the future, 2022 and 2023. Where we are expecting to expand our footprint across European markets.
Thank you. Steve, from your rich experience across multiple organizations and now, how the 2021 was for you?
Yeah, thanks, Samuel. Yeah, I think my three key takeaways from 2021. I think firstly, it was remarkable to see the resilience of the domestic market. I think I was in the UK, but also in a number of the other European markets. We've talked for some time about the demographic bulge, a number of 18-year-olds coming, and we really saw that in 2021. And I think that's something we're going to see for the rest of the decade, which is really positive. So that the strength and resilience of that domestic market was really good to see, and really helped to support some of those occupancy and rental growth data that you mentioned at the outset. I think the second one, again, Rosa touched upon it in terms of the investment side, was really the continued bifurcation of the student accommodation sector. I think we saw that at the investment level. So we saw the really good product, the really good markets, the really good locations was where lots of the capital was chasing, and we saw a real divergence in investment yields between super prime and secondary and tertiary markets. I think we also saw bifurcation at the university level. The high tariff universities continue to do very, very well. the lower tariff universities, less so in a number of cases. And I think we also saw a divergence of performance between the stronger operators and the less experienced operators, shall we say. So I think it's really a kind of coming of age of the sector, both in the UK and across Europe, that the really strong assets and the strong locations with the strong universities, with the strong operators, will continue to do very, very well. And ones that don't tick all those boxes, may find the road ahead a bit more challenging. And then I'd say my third key takeaway from 2021, not surprising as a business which does a fair amount of development funding, was just quite how difficult the construction marketplace was. So I think the supply chain challenges, the material price increases, the general financial strength of the contracting and subcontracting market. So I think 2021 was difficult, but I think we're all aware 2022 is not probably going to be too much easier. So I think, which again lends to partnering with good contractors and us partnering with good sponsors who partner with good contractors. So I think those are my three key takeaways from the last year, Sonny.
Thank you. Nigel, I noticed the Greystar was probably the most active organization in student housing last year. Definitely you appear to be the most frequent in our daily market monitor. I noticed when I statistics from last year. So you seem to be very confident about student housing. Is it in line?
Yeah, we certainly are. I mean, I almost want to, before we talk about 2021, take it back to 2020. And there, certainly my sense was that for investors in student housing, there was somewhat of a kind of existential crisis. So phrases we heard a lot were things like, the death of on-campus study, in the same breath as people saying sort of the death of the city. I think 2021 was a year that really rewarded those that were willing to kind of hold the faith and stick with student housing as an asset class, those that were willing to buy into the fundamentals, which have been proven out again. And then just to echo what the others have said thus far, in the last year, we've seen a real turnaround in operating performance. So for most of our assets, our occupancy is in the high 90s. And rents have recovered to pre-COVID levels, even in places like London. And investor sentiment has turned around. We'll talk about this more later on, right? But there's been quite significant yield compression. So anyone invested at the beginning of last year has probably enjoyed that. But just finally, to echo what the people are saying over here, one of the best quotes I heard last year on real estate was to say that real estate is an operating business. It's not a fixed income asset. It's not a passive investment, and so getting the right sector and the right market is kind of half the battle. But to really extract value, you need to operate that asset effectively. And again, last year was a year where that was more important than ever. And student housing is probably the most operationally intensive asset class for us.
Thank you. And with this, Gorazd, perhaps if I can ask you to pull out the poll questions, question number 1 on occupancies, so that we can sort of feed it in a flow of the conversation. So if I can ask the audience to take about 10-15 seconds to vote, I will read the question for those who might be joining us from the cell phones and might be more convenient for them. So what occupancy rates do you expect for summer semester 2022 on the Northern Hemisphere summer semester, which would be the opposite on the Southern Hemisphere? So basically for the next 6 months or so. And the intervals are broken down by 5%, going down from 100 to 95. 95 to 90 and so on. Gorazd, if you then perhaps once you see sufficient number of the delegates vote, you can then stop the vote. Okay, thank you. So we have results over here as a conclusion of where we are to inform our further conversation on the future. So what occupancy rates do we expect in next semester? So 24% of the audience thinks it's 95 to 100%, 36% 90 to 95. So 60% expect over 90% occupancies, and that's basically the message. Thank you. With this, perhaps I would stay with Nigel for now. So you are one of the greatest operators, and you have a lot of view in different markets across the continents. So are you similarly optimistic about the occupancies, and is it the same across the markets, or it differs somehow?
Yeah, of course. I mean, we're of course optimistic on occupancy, but it, as you suggest, it depends on a number of different factors. And these are things which you can kind of see this in the data over the last couple of years. Probably the single most important thing over the last couple of years has been exposure to international travel. And so with lockdowns and so on, countries like the UK have been especially exposed. Cities like London have been especially exposed, where it's, I think in the UK, it's 19% of students coming from overseas, compared to, I think it's like 9% in Spain. So you're double exposed. Where those students come from, of course, is also important. You have many more Chinese students in the UK, more Latin American students in Spain. So I think like that's the first thing you got to think about, the demand side. The other factor we've noticed as well is whether or not that market is regulated. And this is a theme, I think, which is, it goes across rental housing, right? Rent regulation, depending on the returns you're shooting for, are somewhat of a double-edged sword. If you know that rent is regulated, clearly you're limited in upside. At the same time, it's necessarily more affordable. If it's more affordable and people have different options, then you're just never going to struggle with leasing. And we've seen that particularly in the Netherlands, where we have a regulated product, and it just, if you looked at the operating statistics through COVID, you wouldn't notice much of a difference. So regulation is another thing that affects occupancy, in addition to exposure to international travel. Local market dynamics matter as well. If you can see this in some markets in the UK, if you're just saturated with supply, and there's great data Julia's provided on this, then you're somewhat pushing on a string with occupancy. And finally, and I'm sure everyone on the panel would agree, it really comes down to the operator. Again, like if you can have the right market, the right sub-market, the right deal, but if you don't have an operational team that's effective, that's able to sort of roll with the punches, then you're not going to be able to lease that thing up as effectively.
Thomas, your sort of exposure to different markets is phenomenal, and in America the occupancies are really high. The market is doing very well. UK is close to great. You are also exposed in Europe, but some of the markets you are not exposed to is noticing even greater occupancies. Are you somehow inspired about new regions by these high occupancies, and is it anyhow sort of a factor for Harrison Street to put in an equation?
Yeah, I think for those who have been batting away at student accommodation in Europe, it's effectively, it's a story of many tales, where you really need to understand the peculiarities that are underpinning the various markets. So we were one of the front runners taking institutional capital into continental Europe, and have earned our badges in terms of knowing how to do it and maximize your occupancy with the residences when they get delivered, etc. And I think I echo the sentiment that the UK is firmly back on track now. Our European operations also doing very well now, a bit more of a bumpy last couple of years, but are now back on track. And it effectively, you need to be sensitive to all of these matters throughout your entire value chain in order to get the formula right. And the diversification in terms of what the actual product looks like and how that impacts stuff such as occupancy rates etc., is a feature that I don't think we've heard the last of in the context of Europe. But I mean, we continue to be very excited about rolling out our investment activities and taking it to new territories, whether that being Central Eastern Europe or the Nordics, or reinforcing our activities in some of our core markets.
Thank you. And I will probably go further to some of the trends that we are shaping. And Rosa, you mentioned ESG, and I like your statement that I remember some of the questions a year and a half when investors were asking us whether the new student housing buildings should be ESG friendly or not, and do they have to invest additional million to capex. Then there was a 2021 conversation, and now it seems to be a given that if you are not complying with the rather higher ESG norms on capex and opex as well, then you will not be able to exit 4 or 5 years from now. Do you agree?
I fully agree. And I think there's a lot of consensus now, I think, in the sector around that, which I think is great. And I think for some people it might be a challenge, especially if they don't necessarily have the cash to make those upgrades. I think therefore it might create opportunities as well, which I think is quite interesting. So that's something that we're very actively looking at. Just to pick up maybe quickly on some of the points that Nigel and Thomas just made, which I think are really interesting. So especially on this point on rent regulation, and in that context, these local peculiarities, I fully agree that there has been a focus on affordability, right? And I think what the crisis has shown is that actually the more affordable product should actually create more stable income streams, and therefore should be treated differently from a yield perspective. What we found as well, though, is that it depends very much on how that legislation is actually drafted. So it becomes quite a detailed exercise of trying to understand that, right? Because if you're effectively capped in terms of your income growth in a very inflationary environment where your costs might go up quite significantly, that creates a squeeze that people don't necessarily appreciate in the day one underwrite, especially when you underwrite a long-term hold period, right? So I think that's something that we are certainly trying to get to grips with in some of the markets where legislation has come out quite surprisingly, I think, for the entire market.
Yeah, indeed. And maybe with this bit, Steve, you mentioned the capital markets and the leverage. How do you see this going forward with in 2022?
Yeah, from our side, I mean, all of the points that the other panelists have raised are right at the forefront of our mind, and certainly right at the forefront of the borrowers we're talking to's mind, because we're in this challenging situation of uncertainty on construction costs as well as timings and material availability, significant inflation in the operating costs of running the buildings, staff cost inflation, material inflation, energy prices, and clearly the balancing number in the rest of that really is the rents, but we're up against an affordability challenge in many of the markets on rents. So it certainly makes the underwrites that we look at more challenging. It's probably amongst the most challenging markets of looking at underwrites in the 20 years I've been doing this in the sector, because of some of those uncertainties. I think some of the interesting things that are going to come out, some of the interesting questions I have are what kind of clever design is going to be able to kind of come through to be able to really drive some of the design improvements at a scheme level to be able to meet some of those challenges head on. Another question I think is quite interesting is the locational question. We've seen in other residential asset classes that people are willing to move to what was previously deemed to be an inferior location, move further out of town, move to different locations in return for more space, more quality amenity. So are we going to see that coming through in some of the student housing space? And I think the third aspect, which I think is really interesting opportunity in the student housing sector, is that there is so much Gen 1, Gen 2 product, particularly in the UK, which is obviously 10 years or so at least ahead of many of the European markets. Fantastically located early generation product and university on campus accommodation that is really in need of some much needed love and an uplift. Is there a big opportunity there to really asset manage and uplift and refurbish some of this early product and deliver something which is akin to the modern market requirement, customer requirements, but at affordable rent? Because it's just in the current market, it's very difficult building ground up, fantastic, all singing, all dancing product in the best locations for a rent that is truly affordable.
Well, with this, probably I will ask Horace to put the next question related to the inflation for the Poles. So the number 3 Poles, Horace. And I will introduce it a bit, and I think it will be good to provide feedback to all of us here. Basically, the inflation is quite a big topic for all the hundreds of new developments which are subject of investment. So we are asking here, how has the rising inflation impacted your underwriting for sort of new developments? And there are only 3 options intentionally. One is, I do not expect higher costs to be sustained. So the respondents would believe that this will fade away and we will get to lower costs of construction. Second is, I expect to erode the margins. So the margin erosion which cannot be passed to rents. So I have to feel the contingencies and margin. Or the third one is that I expect higher costs and I anticipate being able to pass higher costs fully on the rents. So in the future. So if you can vote for now, that would be very, very interesting. What is the sentiment of the sector in this regard? As there has been a lot of conversation. Okay, so we can see that most of the people don't believe that this will be fading away, the higher costs, and from the majority of 92%, bigger half is thinking that they will be somehow eroding the margin or contingency, and some almost a half of people think that it will be possible to transfer it to the higher rents in the future. Thank you. With this, perhaps further trends that were mentioned in the presentation, and we have seen last year, the capital demand for portfolios versus the single assets. So we see much more demand from institutional capital that needs to be satisfied rather with portfolios. Many opportunities in continental Europe. So maybe if I can start with Rosa, that where, from your perspective, from your context, do you see the sector to consolidate more and more transactions of portfolios that we have seen previously, or we will still be seeing more single asset transactions?
I think it's a question of what's actually available, right? And looking back and thinking back to some of the charts that you had on size of portfolios across different geographies, I think realistically, the UK, in my mind, is the only market that has a significant enough number of large players for there to actually be more portfolio trade. I think in Europe, the markets are very much dominated by some of the public owners, which probably are going to be, unfortunately, less keen to sell. So in my mind, in continental Europe, there will still be single asset transactions, single asset developments, forward funds, etc. But at the same time, I think the players that will be most competitive and most keen on those deals will be the ones probably closest to us that will be looking to build a portfolio of scale to then trade to a core buyer at exit. So that's probably how I see it. On the portfolio side, we have seen more come out which I think is going to be definitely interesting, especially from some players that were looking to exit perhaps just before COVID hit and have been holding off. So I think we'll see both, but on the continent, I think there just isn't that much portfolio stock available.
Mm-hmm. How does it look like from Harrison Street perspective?
Yeah, I mean, I agree with what Rosa is saying. KKR and Rosa, you know, are seasoned investors in the sector, so they have the finger on the pulse. I think developing out portfolios in continental Europe with institutional capital backing that initiative really started in 2010, 11, 12, and a lot of the people who went in there and got nitty gritty with it realized that you know, it was a sprint that turned into become a bit of a marathon, and developing scale you know, takes a long time over there. So for anyone who wants to do it, you need to be tenacious, and whilst liquidity is becoming better, I think for the foreseeable future, it will still be very fragmented. And I suspect that most of us can probably retire and continue to, within our professional career, focus on student accommodation, and it won't really be a mature market at the point in time when we pass on the baton to someone else. So there's a lot of work to do, but a lot of opportunity. But for anyone who gets engaged, you know, it's all about understanding planning regulations and all the regulatory frameworks we've talked about, vis-a-vis rent control, etc. But yeah, I mean, it's a hugely exciting and rewarding segment of the West Asia market to be involved with. So.
Thank you. And maybe if I can ask similar to Nigel and Steve, but maybe also go a little bit deeper in a way that what we see is that portfolios are sort of traded at a quite significant yield premium. So they are really on demand. There are not that many where we see, let's say, a 5.5 yield on a national level. We see the portfolios being traded south of 5%. So there is quite a big delta for that and a portfolio premium. So Nigel and Steve, what is your view in this regard? So not only on sort of portfolios and single assets in 2022, but also the yield.
Maybe I'll just have a quick stab at that and hand over to Steve. So yeah, we've certainly seen the same thing. There's a handful of transactions you can see globally over the last 2 years. I think Clay in France, and then there was another large one in Australia, and no doubt Student Roost, if that is sold, will probably be sold at a significant premium. But I think it's about how you think about that premium when you look at, say, like a red book valuation or something like that. It often values the real estate, but it doesn't necessarily attribute a ton of value to the operating platform or to the brand that's associated with it. And obviously those things do create value. So the portfolio premiums we've seen have generally been in the range, and you can see this with public market transactions as well, things like GCP, are in the range maybe 10, 15%. But that is not to say it's just goodwill on top of the value of the real estate assets. It's as kind of unaccounted for value, I think, with the operating platform. And, you know, why would you value that? It's simply because of this. When you look at all the different real estate sectors, student housing has one of the lowest NOI margins. So it has the sort of, by construction, the most potential upside from operating leverage, from achieving economies of scale and stuff like that. But I think we've just, as an industry, we've yet to discover a kind of framework to appropriately value that. And that's why you see these kind of portfolio premiums. But I'll hand it over to Steve for more experienced comments.
Thanks, Nigel. Yeah, I mean, I agree with what the other panelists have said on the portfolio premium. Funnily enough, one of the first times we really saw it in the student housing marketplace was when Greystar actually came in and bought the portfolio in London when they bought the Nido portfolio. And I remember at the time we owned part of it through the GSA Coral vehicle, and we were looking at numbers at a particular level, which was doing exactly what Nigel talked about, which was valuing purely the real estate. Greystar came in and acquired it at a very different number, which at the time looked very peculiar, but I'm sure it's turned out to be a remarkable transaction because it did factor in the strategic benefits of getting scale, getting operating platform, and getting crown jewel central London assets. And since then, we've seen many other portfolios and been on both sides of many of them, and successful or otherwise. So we have continued to see it. The other thing I would say is just from a lender's perspective, which has been the last couple of years of my life, we've also kind of seen even in very challenging funding markets and financing markets, we've seen something similar. The portfolio premium is less relevant to a lender, but just the level of competition. We've been out there looking to provide what we thought were very competitive terms for some portfolio financings. We've been blown out of the water by, again, some pretty eye-watering rates. So I think the reality is it's not just the equity investors, it's the debt investors. If they can get access to central London, central Paris, the high-profile global city, either large single asset or portfolios, it's very attractive both on the debt side. So we'd love to be doing more of that, but it's a very competitive space. So I think it is kind of all of the capital stack is chasing those portfolios and those shiny global city assets.
Samuel, can I just give my 2 cents on this yield discussion here, because I think it's a difficult one to have without considering what the product being sold is about. Because when you start to look at what some of the portfolios that traded hand last year, early parts of this year here, and the sharp yields that they achieved, those that looks more akin to a standard residential product, so like a micro apartment, but operate on the PBSA banner, they're the ones that really achieve the sharp yields. And the more amenity-led offerings portfolios out there are likely to have a slightly softer yield profile to it. So I think it's you need to be a little bit careful before you start to extrapolate from single transactions and then apply that to your investment decision making.
Thank you. And Goraz, if you can pull out the number 4 question about the yields, that we can have a vote, so that we can have a temperature check for the next year. So the question is, how do you see yields developing over 2022? So strong increase, slight increase, stable, slight compression, or strong compression. So this is pretty much straightforward. Maybe Goraz, you can keep it for about 20 seconds so that enough people have time to vote. Yeah, so we should have results right now as we have. So I'll read it. Strong increase 4%, slight increase 21%, stable 26%, slight compression 42%, and strong compression 7%. So we have about the major sentiment about 2022 is that it should be stable, rather stable, or slight compression. Thank you. With this, I would move to markets of the future. So if our panelists can have their say, from our perspective, there is a big chase for the big 6 countries in Europe, which is UK, Germany, France, Spain, Italy, Poland, that offer portfolio advantage, but also new markets that higher IRRs can be achieved, especially Italy and Poland are very hot these days. And then small and secondary markets. So a lot of investments, new investments in Denmark, Austria, Portugal. So what is your view on the markets in 2022 that will be on demand, and be it sort of from a transaction point of view, so buying operating assets or investments to new developing assets? And if I can start with Steve.
Yeah, thanks, Samuel. I mean, from my perspective, I've spent most of the past decade working with the GSA team being pioneers and going to new markets and having to create a sector where it hasn't existed. So part of my DNA is about looking at new opportunities and looking to shake stuff up and create something where there currently isn't something. So I mean, I agree with the kind of the leading of the question, which was that there are some emerging markets which could produce some really compelling opportunities. I think the challenge, as we've already talked about, is scale and just time it takes to build those markets. And when at GSA we went in and created a market in Australia or Ireland with the Harrison Street team, in Spain, there was less institutional capital around. There were less of the big guys around. So we had a bit more time and we could be a bit more thoughtful, and we could help to create that sector. There is so much capital chasing so much product at the moment that I just think it's harder to make a serious kind of institutional grade case for doing too much in these smaller markets where there isn't yet a sector emerged. So I suspect through 2022 and the next couple of years, I think the big six, as you refer to them, will continue to get the bulk of the capital, the real kind of following, the yield compression, rental growth, and just because that's where the scale is. I think at a smaller individual developer level or operator level, I think there'll be some fabulous opportunities in the Nordics, in some of the Central European markets, in some of the small and Southern European markets. So I think there are many markets where the fundamentals are fabulous and totally compelling. I just don't see the big institutional capital moving into those markets and therefore driving the pricing and driving the transactions for the next couple of years, because it just takes at least a handful of years to get anything of sufficient scale to make it attractive to the institutions.
Rosa, if I can ask you for your view.
Yeah, I mean, sorry, was it Rosa?
Oh, sorry.
Rosa, can I ask you for your view?
Yes, of course. I have to agree with everything that Steve said. I think we're all very curious people, and I think we like sort of exploring new markets and getting to grips with the local peculiarities and just trying to source deals and do deals. That being said, I think what Thomas said before is still completely right. It is a very granular market, and that sort of effort to gain ratio of exploring new markets, I think, is getting more tricky. On our side, we're now deploying a fund that's 2.2 billion of equity for value add, plus probably 1 billion per year of core plus. And so we need to really focus on where the opportunities are. So I agree that I think the largest markets are continuing to capture more attention. I do think also that in some of the smaller markets you mentioned, depending on the local regulation, student housing is viewed by the local investor community as quite close to residential, perhaps. And so I think that the value add of actually trying to tackle those markets with a more pan-European student platform mindset is perhaps more limited, because pricing is already driven up by these local investors who charge a very limited yield premium for the student housing sector versus build to rent.
Mm-hmm. And Thomas, you wanted to say?
Yeah, I mean, we differ slightly from other investors in this sector here, insofar that our modus operandi goes via supporting integrated developers and operators who then transact in whatever vertical that they're active in. This case is student accommodation. Harrison Street as an asset manager invests across multiple alternative sectors. So we are very excited about supporting our existing partners in their efforts to business develop across Europe, and some of them are very advanced in their thinking about where they want to be and how they want to execute and what they want the product to look like. So again, just to be clear, we will never really take a stake in the operations, but our partners undertake those activities. So I'm confident that we will plant the flag in new territories during 2022 and indeed expand our portfolio of partners, so we can we can support in their efforts, into new jurisdictions, Central Eastern Europe or the Nordics, or wherever that might take us. Certainly, anyone who looks at the stats can easily get convinced that there is an opportunity to do student housing almost across Europe, really.
Mm-hmm. And Nigel, and I want to just emphasize that some of the questions from the audience that are coming, Stephanie is sending me some of the abstract from them here. So most of the people are basically asking straightforwardly, what are the markets of the future for the next 10 years across Europe? So I'm just passing. It's up to you how you answer, but it would be nice to have some of your views here.
Sure. Well, I'm sure we can't give too much away, but I think everything that's been said so far, I kind of agree with the opportunity in some of these peripheral markets, say Central Eastern Europe, Iberian Peninsula, is fantastic. You've got strong demographics, slightly different demographics in terms of the groups they're coming from. Portugal, I think, is a particularly interesting market insofar as you've got, Portugal is not a very large country. Brazil is a very large country. You've got a lot of Brazilian, you don't need many Brazilian students to move the needle in a city like Lisbon, as an example. And similarly with Central Eastern Europe as well, you've got migration flows from elsewhere. When you look at the yield, it looks especially attractive, and so from a kind of top-down perspective, you probably want to go into these markets as soon as you can. The challenge, of course, is that the rental values are so low and the yields are so high, it's really hard to put money to work at any kind of scale, which I guess the earlier discussion is exactly what people are trying to do. Additionally to what's been said before, there are all these kind of frictions in setting up a new business, essentially, in a new market, getting to grips with the local customer requirements, with the rent regulations, and so on and so forth. So I think it's a fantastic opportunity. There's great returns to be had in these kind of, let's call them peripheral markets. It's just, you may not be able to deploy significant scale in order to get those economies of scales that we talked about earlier on. So as I talk it through, I sort of think there's almost two kind of strategies, right? You either kind of sharpshoot on the periphery for high returns, or you go for portfolio scale in the big six. But it's hard to do both of those things at the same point in time, I'd say.
Great. With this, I would like to encourage our audience to put more questions if they wish in chat or Q&As, and Stefan will provide some of them. I would move to next topic, which is the product and student preference. Based on the sort of mystery shopping we do, occupancy levels, and student surveys that we do, we see that there is a more and more propensity towards single rooms and studios. When it comes to amenities, it's not that simple that the more the better, but it's much more about the correlation in between what the market wants and what is useful for the capex. And we see more preference on student preference on ESG during operations, so that the operation is ESG friendly, that the students as a tenants or clients care. So I would like to ask our panelists in terms of product and student preferences, where they see the shifts or trends that probably will continue in 2022. And if I can start with Nigel and Thomas, that has probably the wider pool of experience when it comes to the portfolios, then that would be appreciated.
Maybe I'll just jump in with a couple of key points. I think, like, one of the most important things, what apparently, according to the UCAS Knight Frank survey, is the most important thing, is Wi-Fi speed, which is not necessarily a differentiator, but is what you might call like a hygiene factor. So it's a minimum standard. One of the things we learned in the UK early on in a building, I can't remember any of the stats from this. This is a building somewhere in North London a few years ago, but the Wi-Fi in a student building went down for, I think, like a day or two, which, you know, was slightly more serious than turning off the water or the heating in winter. It was like the amount of inbounds we got from students was just, I mean, it was ironic as well, because I guess they're phoning in with them. But that as a hygiene factor is, you've got to get that absolutely right. And when surveyed, students in the UK asked, what's the most important thing? Number one is Wi-Fi. Number two is how large the apartment is, which is interesting. So, you know, that's one thing. In terms of, well, like the new kind of way of studying, hybrid learning, where you're spending some time on campus, some time at home, very much similar to multifamily. The ability to cater for those work from home trends is important. And of course, you know, for younger generations, ESG and the building's energy efficiency are also very important things, but I'll leave it there.
Thomas, do you see any trends for product preference?
Yeah, so again, I think the picture, generally speaking, needs to be a little bit more nuanced, because there are multiple strategies to be deployed out there. Certainly, overarching all of that, you know, is this Anglo-Saxon amenity-led model that seems to be rolled out by the majority of the international investors / developers out there. But I do fundamentally think that affordability is something that we all need to be thinking about, because students inherently they live on a budget. So to the extent it's possible to develop out stuff that is affordable, you know, that will then influence what the actual product looks like. But I mean, in terms of what they value, you know, we talk about internet, etc., and all of that, you know, remains. I think the integration with technology is also very interesting, and see how that influences the service delivery going forward from here. We talk a lot about student welfare and the ability to try and cater to that via creation of app-based platforms, so you can then provide a more tailored service to your students. I think is something that will become increasingly relevant, you know, amongst operators who has that scale and can implement those type of investments in their operating model.
And Ross and Steve, in this context, any views on the product preference in next year or this year?
Yeah, I would agree with again everything that was said. I think the sort of studio question, I think it's an interesting one, because you really have the two contrasting trends of people wanting more privacy as a result of COVID, but then the affordability issue obviously becoming quite pronounced. So I think what people are seeing is that the cheapest and the most expensive rooms tend to let up quickest, and then it's everything that isn't quite clearly positioned that takes a bit longer. So I think that there's no clear answer to that. On the amenities, again, I think demographics are really important. So who is the student that you're actually trying to please and to activate those spaces? So I think because we've seen that can change quite quickly depending on where the visa situation goes, etc. I think it's just important to have spaces that can be used flexibly going forward, and as you go through these cycles of different demographics. And I think the quality of staff to actually animate those spaces is really key, to actually get people to use them, understand what people want, what sort of activities they want. I think that's really crucial.
A very good observation, and I can confirm also from our data when we do these operational benchmarks that the rooms that are well positioned either towards the privacy or affordability, they fill up first in the mobilization of occupancies, and whatever is not positioned is probably the last, if even gets occupied, even on the cost of discount sometimes, like the double rooms or shared rooms. But Steve, do you have any view here?
Yeah, I'm just going to comment particularly on the single room and studio point. I've heard this quite a lot over the past 12 to 18 months or so. I think, you know, primarily driven by the pandemic and the kind of isolationism that has thrust upon people. And I find it quite interesting and slightly concerning, because I still think one of the primary purposes of what we're doing for our customers is about bringing together a sense of community, helping them to build those bonds and lifelong friendships, work together, study together, play together, do all of that in their buildings. And I find it slightly concerning, this thought that we're going to build all of these insular single unit rooms So now the reality is, if that's what the customers are saying and they're being asked the right question and understand the question, they're answering in the right way, then that's what we need to react to. But I just don't see that being the case, because every time I visit the premises, either GSA's premises or the premises we're lending on, it's a sense of community that really comes across to me, and I think it's very hard to deliver that in a scheme which is full of single occupancy units, and also the well-being and mental health of our student residents. Isolationism, loneliness is a massive point, and that clearly flies in the face of that. I do question whether that's really what the customers want and that's really what we should be building. And I think that's further exacerbated by what I see as a real kind of re-emergence of the domestic customer over the next decade, where I think international customers coming in paying top dollar, they want 30 square meter studios and all of the best amenity. That isn't the market that I think we should be spending a lot of our time focusing on over the next decade or so, which is the domestic market in UK and European markets. So I think we need to be producing a much more mixed product, a much more affordable product, and one which really brings great amenity, brings our communities together. People want to work by themselves, want to live by themselves, that's fine, but I don't think that's the majority of the customer.
As we are heading towards the conclusion of our session, and we reserve the last 10 minutes for Q&As, I have some abstract from the questions that Stefan sent me. Basically, they are mostly circulated about three major topics, which is capital origin. So the audience is asking, where is the most new capital mostly coming from? The second one is, how do you see the non-European markets? So be the US or new markets like Canada, Latam, Australia. And the third one are forward deals. Mostly people are asking that as we see more capital but not so many opportunities on among operating assets, whether the institutional investors will be more open to forward deals for new developments. So I would probably start with the first one, with the capital origin. Where do you see the additional capital coming from? If you can enlighten the audience that is asking. And please feel free to take on. Maybe Thomas and Steve may start here first, and then we can go on.
Right. Okay. I can start off then. I mean, here in Harrison Street, we have just recently completed our fundraise for our third European fund series, and we exceeded our expectations in terms of capital we were able to raise, and got support from some newcomers, and a lot of our existing LPs reaffirmed their commitment to our investment thesis. So it's clear that the journey of making this an institutionally accepted asset class continues. And from that perspective, we have investors basically from all over the world, dry institutions down to family offices who can see the benefit of working with an institution like Harrison Street and the way we conduct our business. And I would expect the trend to carry on. In short, that's it.
Maybe one point to add to that, I think that all the different sort of living asset classes are starting to blend together in different ways. So I think hospitality, student housing, micro living, residential for rent. I think there's more and more overlap between these asset classes, and so we're seeing people branch out from one to the next. So I think that means that overall the pool is going to get bigger, and actually the skill sets looking at these investments are growing, which I think is quite exciting.
I was just going to add, I think one of the interesting points which we haven't had for the last few years or few decades is the inflationary environment and the interest rate environment, which is moving from a very benign interest rate and a very loose monetary policy to a significant sharpening of monetary policy in a number of the major global markets. And it'll be really interesting to see what impact that has on capital flows. My expectation is that North American capital for UK and Europe will continue to make up a good proportion of the total, but it will be really interesting to see as interest rate rises, inflation rates, exchange rates all move at differing paces in the developed world or in the major markets, what impact, if any, that does have. It's going to be a pretty interesting year for the capital markets and capital flows, I think, everything that's going on.
Nigel, do you have any view here? Is it Asia? Is it America? Is it any other capital that is attracting Western housing?
Yeah, I think it's hard to generalize about a particular type or a particular region. One thing that does seem common is that, and I think this is something that's characterized the last few years in asset allocation, is there is this kind of search for yield at the same time as, and that's like at the sort of highest level of portfolio allocation. And then when you think about real estate, everyone's trying to rotate to, housing and logistics, or so-called beds and sheds strategies. In the UK, at least, it's the most liquid and the largest and most developed of the bed sectors. So I think it's just a natural function of people trying to allocate to the bed sector that they end up looking at student housing. Elsewhere, I guess people are looking for yields. What's really interesting as well is when you look at it, again, it's hard to say which particular markets they're coming from or which particular markets they're going to. But when you look at the spreads, so to Steve's point, you've got rising rates, that's a concern. Obviously, the more spread you've got over the 10-year, the more protection you have, all other things being equal. It's not necessarily that simple. So you want to look for those that have a spread over the 10-year, and then also those student housing markets that have a spread over multifamily. And what's interesting, and I'll get to the punchline now, is when you look at all the student housing markets around the world, the student housing premium spread, if you want to call that on the yield, ranges from 50 to 450 basis points, according to the sort of data we look at. So there's still a lot of room to run and still some significant opportunities. But those aren't local opportunities that we spoke about maybe earlier on. They're big, high-level global asset allocation opportunities. And there, you have to have a broad remit to capitalize on that.
Thank you. Maybe one more last question on sort of new markets outside of Europe. So we have people from India here, Australia, Latin America, Canada. How do you see this as an opportunity, or in terms of time, when those markets might be more investable in perspective of the capital? Steve, you?
Yeah, I mean, from a Kinetic perspective, we're very much focused on the European markets for the next 2 years. So I can talk more broadly from my GSA experience and sister business. GSA have just over the last couple of years gone in and bought a few portfolios in the US. So rather than going into emerging markets, they've gone into the most mature market, and that's principally been driven by the fact that they can get significant scale in that market very quickly. And they also don't believe the current operators in that market are doing a terrific job, and there's an opportunity to really shake it up and do something that isn't being done in that market because they haven't had to do it. So from a GSA perspective, a lot of our focus has been and will continue to be on getting significant scale in that market. That said, I think they are the kind of most pioneering of all the student businesses, global student businesses out there, operational in nine markets, and have got businesses in Japan, China, Australia. So they continue to look to grow those businesses. My personal experience of some of those other markets, which just really reiterates the point I made earlier, is it takes a long time. There's the getting to understand the student housing sector, the universities, the development market, but it's also the local sales taxes, the VATs, the taxes, the legal structures, all of that. So it does take time. So again, I'd say I'm sure there's some fabulous opportunity. I mean, India, I think it's the second largest student market in the world. Of course, there's opportunity out there, but you've got to have the right local partners, and you've got to be willing to invest 3 to 5 years to go in there, understand the market, and develop anything like serious scale. So I think there's fabulous opportunity in some of those big markets, but it's not for the faint-hearted. So that's my take on it. Great opportunity in many markets, but you've got to go in and be very committed to it.
If I can ask the other panelists with 1-2 sentences on the new markets, overseas. What is their view so that we can conclude them?
I'll give you my 2 cents. I mean, echoing everything that's been said so far, I think that opportunities exist globally, but you need to be tenacious about it. And I think for Harrison Street to roll out our franchise into to Asia or a place like Australia, for example. I mean, we continue to survey those markets. At some point in time, there's no doubt we will start to roll out our activities. And it tends to be on the back of partners that we already work with who want to set up operations in new territories, and then we will follow them like that.
Yeah, I think for us, it's a similar story. We have franchises out across the globe in different geographies, and all of them have student housing very high up on their agenda in terms of investment targets. But again, I think it's, you have to be aware of all the local specificities when you get into the space.
Thank you. Nigel, you want to add? Or?
Yeah, just I guess to summarize what's been said already, I think it makes sense to to look for yield in these markets, to look for a portfolio premium with a kind of roll-up strategy. But it kind of goes without saying, if you want that portfolio premium, you're going to need to build a platform, and clearly after everything that's been said, that takes time.
Great. Well, thank you very much. We are concluding the time allocated for the session. I truly appreciate also in the name of the audience, your time, your willingness to share. I hope I could balance the topics as much as it is of interest of everybody. And also thank you for the audience to come, to participate, to pose questions. Again, we couldn't answer all of them. There are more than 100 questions. So I just want to repeat that the annual report will be available on request on bonard.com/presentations, or you found the link in a chat. And of course, if you have more requests for information or data or advisory, we at Bonard would be pleased to be considered. And with this, I wish we will be able to meet in person as well, or either individually or at some of the events that we usually used to have about 10 in industry. So with this, I wish you all the best in this year, and hope to meet you in person later on. Thank you very much.